everyone, I'm Astha Khurana and welcome to Zerodha Varsity Videos. We are on episode 8 where we are discussing Warren Buffett's letters to his shareholders and we are on this journey of crash course. With me, I have Satya and Vineet from Team Varsity who will help us on this journey. In the previous episode, we talked about financial crisis, how real estate business was able to handle those crises. Along with that, Warren Buffett did enter finally into tech stocks. Also, he did mention some of his mistakes and learnings to take home. Lastly, he did name the successor in the investment segments. In this episode, we are going to discuss so much more, so let's begin. So Vineet, in this episode, we are discussing the years from 2012 to 2016 and otherwise I ask you what is the agenda for the video. But over the period of time, with every passing episode, I've realized we talk about acquisitions, some businesses, mistakes, lessons to take home and something around succession planning as well. So apart from this, what are we discussing?
Well, since you've already laid out the agenda, let me begin with two stories that Warren is talking about in 2013, I guess. So the first one is he's saying that in 1986, his son Howard wanted to buy a farmland and Warren paid for it. It was a 400-acre farmland and they paid $280,000 for it. Warren said that he didn't know anything about farming, but he depended on whatever his son was saying. And Warren was estimating that he would make a 10% IRR over a long term on this investment. So he invested. 28 years since, Warren has only visited it the second time in 2013 and this farmland has grown 5 times in value and has been giving thrice the earnings that it was giving initially. The second investment is a commercial real estate property in New York that Warren invested personally again with a group of his friends. He has never visited this property. So the basis of this investment was that the anchor tenant was paying $5 per square foot while the others were paying $70 per square foot. In the 9 years when this tenant's agreement would expire, suddenly they were going to see a good spike in their rental flows. So Warren bets on that and he invests in this property. He's never visited it. And he's saying that this happened in 96, I think. And no, this happened in 93. And since then, they are making 35% return on their initial equity. And overall, so far, the distributions have amounted to 150% of their initial investment. So both these investments were not similar to what we have been seeing in Berkshire Hathaway. These were his personal investments in different sectors. And look how well they've turned out in the long term for him.
That's very true.
Yeah. We can safely say that these two investments are successful for Warren Buffett. Just like Warren always wants to share his wisdom with other shareholders, he also talks about these investments. He mentioned 5 points every time, 4 to 5 points. The first point is he says, you don't have to be an expert to get satisfactory returns from your investments. Keep it simple and if someone says you can make quick profits, say no to them. The second is, just like as he says always, if you don't understand any investment product, don't invest in it. He says you have to at least, you have to be able to estimate what you are getting from those investments. It's not certain what you would earn from any investment product, but at least you have to have estimate on what that would earn. The third, talking about estimate is not speculation. He says don't speculate when you are getting into an investment, saying that, okay, fine, I'm investing now, maybe in 2 months or 3 months, this money will, double or triple. The fourth point is, just as he never visited his New York property, he asks us not to check the valuations of the investments that we made daily or more frequently. He also refers this to an example, says that a team of players, they don't win the game focusing on the scoreboard. They win the game because they focus on the game itself. So he's asking us not to focus on the valuations daily or much frequently. What he is referring to is have a long-term investment, don't fret much. The fifth point is don't listen to pundits. I don't have to expand on this. He's saying, have your investments. Don't try to understand what's happening in the market, macroeconomics, etc. Keep it simple is what he is referring to.
You know, if I want to summarize into the lessons that we have derived from these two stories, I think it's for the retail investors to understand that long term is the one thing that will actually help you make wonders. Don't listen to those pundits or those financial advisors as to what to do with your portfolio and, you know, that churning it again and again, buying it and selling it, because that is how they are going to make money, but that is not the journey for you. Stay calm, stay invested for the long term, because patience is the key to success and you will be making good returns, and that's that.
Yes, in the long run, your investments will deliver good returns, and in fact, Warren is proving that by explaining rolling returns.
Okay, before you expand on that, let's first understand what are rolling returns.
Yeah, before we get to it, let's try to understand what a point-to-point return is. Say you want to know the 5-year return on the stock that you bought. You want to know the value as on December 31st, 2023. So you take the starting value, which is on December 31st, 2018. You take December 31st, 2023 value and see what is the return. So this is the point-to-point return from one point to another point. But anything could happen on these particular days, December 31st, 2018 or December 31st, 2023. The market could have gone up drastically. The market would have corrected so much. So you told yourself that, okay, I'll check the 5-year return of this stock every day in 2023. So you start with January 1st, 2023. For that, you need the first data point that you need is January 1st, 2018 to January 1st, 2023. Second data point is January 2nd, 2018 to January 2nd, 2023. January 3rd to January 3rd. So the last data set, the last data point will be December 31st, 2018 to December 31st, 2023. So once you get the 5-year return on each day in 2013, you average it. So that's the 5-year rolling return during 2023. When you are looking at rolling returns, 3 things are very important. The year, you know, the return year, what you're looking at. Here in this case, we have looked at 5-year return. And the time frame. What is the time frame here? From January 1st, 2023 to December 31st, 2023. 2023 is the time frame. The third one is the frequency at which you are checking the returns. You consider daily 5-year return. But maybe Vineet could say that, okay, I will look at only weekly. You could say, no, I will look at only quarterly. Every quarter you see the 5-year return. This is what the rolling returns is. By looking at rolling returns, you can analyze how the returns are during a long period of time, which will also eliminate the, the risk of volatility.
So in fact, Warren is saying that if you compare Berkshire Hathaway's growth in book value with S&P 500's growth, you will see that in a 5-year rolling period, Berkshire Hathaway has been outperforming S&P 500 in every single period. When this period starts, this time frame is from 1965, when Warren and Charlie took over Berkshire Hathaway, till let's say 2013 or 14. So, and the period is 5 years. So 65 to 70, 66 to 71, 67 to 72. That is the time frame. Frequencies every year. He was calculating this every 1 year. So this 42, 43 periods that you get, you take an average of that. He's saying that in each of these rolling periods, Berkshire Hathaway has managed to outperform S&P 500. He's saying this in 2012, and why is he bringing it up? He's saying is that so far Berkshire Hathaway has managed to outperform, but the past 3-4 years Berkshire Hathaway has been underperforming in 1-year periods. So if that underperformance continues in 2013, there's a good chance that they will have a first ever 5-year period when Berkshire Hathaway would have underperformed the S&P 500. And in 2013, you will see that it actually happened. Berkshire Hathaway underperformed the S&P 500 over a 5-year period. However, very conveniently, Warren is not talking about rolling returns in that letter. He's simply saying that if you look at it from the end of 2007 to end of 2013, basically this 6-year period, Berkshire Hathaway has outperformed S&P 500.
You know, this reminds me of a story about my cousin who went to a skating competition and he came third. And then he was boasting about it that, see, I came third, and we were congratulating him. Later only we get to know that there were only 3 participants in the race. So, I mean, as to draw the comparisons, very conveniently, Warren has shifted the time period from 5 to 6 so that outcome looks better. The way my cousin hit the fact that there were only 3 people to make the outcome look better. But nonetheless, Warren Buffett, I mean, if we compare it over a very long period of time, they have been doing better and they are doing better.
Now, if you see Berkshire Hathaway, every year letters, the first page is where the return comparison is there. So each calendar year, what is the growth in the book value of the company and what is the growth in the S&P 500 market value. In 2014, he also started giving the market value of Berkshire Hathaway. Earlier, it's only book value. Now there is a book value, market value of the company and market value of S&P 500. Why? He always believed in intrinsic value of the business. So he wanted to show how the intrinsic value of the company is going up each year. And book value is the nearest proxy to show the growth in the intrinsic value, and that's why initially he decided to show book value of the company against growth in the market value of S&P 500. But over the years, the divergence between the book value and the intrinsic value is widening. That we'll get to know later. So he realized we cannot show book value alone. So he wanted to show market value also. So we all know that the book value is different and the market value is different. Book value is dependent on book value or the intrinsic value is dependent on the fundamentals of the company, the future earnings of the company, etc. Fundamentals is the main point here. When it comes to market value of the company, it is dependent on the supply and demand of the shares, the economic sentiment. Of course, it also depends on the earnings prospect, but it's also dependent on the market sentiment. What Warren is saying is, in the long run, the market value of the company and the intrinsic value of the company converge. That means, in the long run, people go invest in the company and the prices reflect the true worth of the company.
Yeah. So in the initial years, yes, the book value and intrinsic value were going together. And towards the later years, the intrinsic value is converging more with the market value. Hence, the market price is being brought up. Now, why was this divergence happening between book and intrinsic value? In the initial years, most of their investments were listed securities. Now they have made acquisitions of massive private organizations such as Mid-American or BNSF. These are worth $20-30 billion each. So now there are 2 ways why these privately owned businesses are impacting intrinsic value and causing the divergence from the book value. One, firstly look at float. Now, float by this time was around $84 billion or something, and by the end of this period, that is 2016, the float had gone up to more than $100 billion. Mind you, by 2016, Berkshire Hathaway had 14 consecutive years of free float. They had underwriting profit, so in fact, they were getting paid to keep this float. This float was adding more value. They were able to invest it and they were able to make money out of it. So this float was in fact adding value. Now, keep these words in mind. The float was adding value. However, it is recorded as a liability in the balance sheet because it is not Berkshire Hathaway's money. It is the money that has to be paid back to the insured customers. So he's saying that this is recorded as a liability, but this liability is not going to come calling entirely in a day or 2 or even within the year. They have a lot of reinsurance policies which run over a few decades. Even if the float were to decline, it would decline at just 3% per annum. So all of this liability was not going to come calling immediately, but it was going to yield them value over the subsequent years. So this liability brings down your equity, but it is in fact adding to your equity. Yes. So it has that intrinsic value to it. The other part is depreciation, which is which is having the opposing effect. Now BNSF, which is the railroad company, they are recording some depreciation according to US GAAP standards. Warren is saying that the replacement cost of the equipment or of the railway lines that we are putting is much more than the depreciation that we are providing for. So let's say you're providing for 20 million in depreciation, the actual replacement cost is going to be much more than that. So he's saying, in fact, what the book value is showing, intrinsic value is perhaps lower than that.
So basically, in these two cases, let's talk about float first. The book value was falling because we couldn't account for the intrinsic value, but it was opposite in the case of depreciation, where book value was rising, but actually the intrinsic value had fallen. Very nicely explained, Vineet. But there is one thing that I want to ask you. You were explaining this within context to what happened with BNSF. So is it like a word of caution or problem for BNSF right now because of the divergence?
Oh, no, not at all. In fact, Warren is very proud of his investment in BNSF and also Mid-American for that matter. Mid-American Energy was in fact renamed Berkshire Hathaway Energy around this time. Now, both these companies put together were contributing to 33% of Berkshire's overall earnings. However, Berkshire was not making any dividends out of this because these businesses invested in long-lived utility assets. They required continuous investment in building up, in adding up their network. So for years and years, they have never given any dividend to Berkshire Hathaway, and they have been reinvesting all their retained earnings. But Warren was okay with it because they were eventually adding intrinsic value to Berkshire Hathaway.
So they were able to do this all because of the capex?
Yes, they were doing a lot of capex. They were spending billions and billions of dollars in their equipment, in the railway lines, or in the network that they were building. In fact, they were the largest railway network in the US, and they were spending more than twice of what the second largest competitor was spending.
Indeed, Warren was very proud of investing in these companies. Remember, they are like utility companies and are regulated. So he was also sweetly hoping that the regulator will allow them all the approvals to do more capex and do more business. He also wrote this that the regulators, should act in such a way that the capital providers, because, Warren Buffett and Berkshire Hathaway, they are considered to be capital providers. The regulators should act in such a way that the capital providers bring in more money so that the nation could benefit from the infrastructure and the rail projects that they are getting into. But he is also telling his CEOs that we should operate the companies in such a manner that we get approvals from the regulator fastly.
Wow. But then, Vineet, a lot of capex would also mean that they were taking a lot of debt. So how was they managing that?
Yes, they were taking a lot of debt, and it was adding up to the consolidated balance sheet of Berkshire Hathaway. But Warren is saying that these liabilities are not Berkshire's. These liabilities are only owed by BNSF or Mid-American Energy, which was Berkshire Hathaway Energy by this time. He's saying that these companies were very well capable of servicing their own debt. He's saying that they had an interest coverage ratio of 9. Now, let's understand, Satya, what interest coverage ratio is.
Okay, let me try to put it simply. Say the interest on a home loan is about 10 rupees and we are getting the take-home salary of 100 rupees. So the interest coverage ratio in this case is 100 divided by 10. That is 10 times. So we have 10 times the money to cater to the interest that we have to pay. Yeah, it is calculated by EBITDA by the interest payment that we have to make, or the company has to make. EBITDA is earnings before interest, depreciation and taxes. Why do we consider EBITDA before depreciation? Because depreciation is a non-cash expense for the company. So that's why the EBITDA is considered, and divided by interest payment gives the interest coverage ratio.
So Warren is saying that you should not look at EBITDA. You should look at pre-tax earnings by your interest expense. Now let's take an example. If your EBITDA is 100 and your interest expense is 20, so 100 by 20 in that formula, you have a coverage ratio of 5. Warren is saying that you cannot ignore depreciation. It is an actual expense. So you should, let's say that the depreciation was another 20. So 100 minus 20 is 80. You should divide this 80 by the interest expense. So 80 by 20, 4 is your interest coverage ratio. Warren is saying that this more difficult metric of pre-tax earnings by interest expense was 9 for these companies. So he was in fact boasting that they are capable of paying their own debt. We don't have to worry about it.
Nice, really nice, because he understands that if interest is your expense, so is depreciation, then why do you consider EBITDA while calculating? Consider both the expenses and only then calculate what will be the right metric for you.
Yes.
So Vineet, now that we are already discussing about the existing businesses, that is BNSF and Berkshire Hathaway Energy, let's discuss some another existing businesses that Berkshire Hathaway is into, and let's start with the very favorite, insurance.
Sure. So around this time, the highlight is Geico. That is Warren's favorite baby. He's saying, whenever I count my blessings, I count Geico twice. Really? And so he's saying, he's enumerating the strengths of Geico. There was Hurricane Sandy in 2012 in New York, and 47,000 auto insurance claims came knocking at Geico's door. Geico serviced all of them and was still profitable on an underwriting basis, so basically added to the float. Their float was still free.
Wow.
And when they acquired Geico fully in 1996, it was the 7th largest player in the US with just 2.2% market share. Around this time, it has crossed 12%, and now they are the 2nd largest auto insurer in the US.
Second largest insurance company back then. Warren is also wishing that it would become the largest insurance company in the US by the time he turns 100 in 2030 on August 30th.
Yeah, he says mark your calendars.
Yeah, mark your calendar.
Really nice. Insurance business has already something interesting facts to state. But Vineet, in the previous episode, we discussed about how globally every market was hit by them. And we did discuss that Warren Buffett via Berkshire Hathaway was invested in real estate business, Clayton Homes being one of them. So where are we now on real estate business?
So in 2013, almost 5 years after the peak of global financial crisis, is when Warren is saying that finally home sales are picking up. And now Clayton is the largest home manufacturer in the US by volumes, not by revenues, because they were catering to the lower middle income group people, and their houses were less than $150,000 each. However, they have also ventured into site-built homes where they would actually manufacture or build the house on the site. And he's expecting that very soon these homes will contribute 3% of their total volumes, but 14% of their revenues, because these homes are valued more.
Wow, this will be some nice productivity figures that we'll get to see in Clayton Homes.
In fact, yeah, productivity is also something that Warren is talking about.
Okay.
Because they've covered 50 years so far, and he's showing how his businesses have improved their productivity. Let's start with BNSF. In the last 20 years, that is 1996 to 2015, they have increased the volume transported by 71%, whereas their employee count has gone up by only 4%. Let's talk about Geico. He's saying that they have 34,000 employees servicing 14 million customers. And this is because Geico is a direct-to-consumer insurance business. If it were a conventional insurance business, which goes via agents, they would need 60,000 such employees to cater to 14 million policyholders. So there is a lot of productivity gain in Geico as well. And also the internet is supporting Geico sales a lot.
Right.
Then BHE, Berkshire Hathaway Energy. And Berkshire Hathaway Energy, in the past 15 years, their employee count has gone down from 3,700 to 3,500. 200 employees have reduced. But their production has gone up from 19 million megawatt hours to 29 million megawatt hours. And it is this productivity gain that has allowed them to not increase rates for these 16 years at a time when energy rates have gone up by 44%.
Wow. You know, when you talk about how well Warren Buffett has been able to do with productivity in Berkshire Hathaway, that is really commendable for Berkshire Hathaway as a whole, for the shareholders where the value unlocking is taking place. But there is one social concern that comes to my mind is that the way the productivity is increasing, but the number of employees are decreasing, which means that there is a replacement happening. Technology is taking over. And in contemporary world as well, we see ChatGPT being in trend, taking up people's job, AI being in trend. So productivity-wise, great. But I feel that there is some social concern that also needs to be looked upon.
Yeah, Warren has views on this as well, on the productivity gains. He says he's of course pro when it comes to productivity gains. He's supporting it. He's referring to this with a farming example. Earlier, a set of farmers used to work on a land and the yield used to be, X%. Now with the advancements in the technology, the yield has gone up by maybe 10% or 20%. The number of people working on the farm have come down while the yield has gone up. The number of people who are now not participating in the farming have actually been working on other projects which are producing products that you and I use to improve our lifestyle. So he's supporting the productivity gains, but he's also saying that the productivity gains have a negative effect, as you're saying, socially. Productivity gains are largely benefiting the wealthy people. That's he's saying. The second point he's saying is, while that is happening, the technology, advancements in the technology and the productivity gains are negative for two set of people. One, those who are providing the capital. You invest in a company and then there is a technology advancement. Of course, your capital is gone, right? The second is when there is a technology advancement or the productivity gain, there is someone who is losing the job. As you said, there are only fewer number of people who are working on the same project now. Talking about the people who are providing the capital, he's saying that these people should take care of themselves, because when there is a profit, they're all happy. When something is going wrong, they should take care of themselves. But Warren's concern is on those people who are losing their work. So what he's urging is that there should be policies that should help productivity gain, but there should be also a safety net for people who are losing jobs because of the productivity gains.
Very nicely quoted.
So technology advancements have in fact disrupted a lot of industries, newspapers being one of them, and we are seeing how Warren keeps on referring to the decline in newspapers. But very uncharacteristically, in 2012, he's bought 28 new newspaper companies for $344 million.
Wow.
It's so strange that he has been very vocal about the falling profitability of the newspaper companies because of the decline in the circulation, decline in advertisements. I wonder how he actually bought 28 newspapers. You also said $344 million.
Yes.
It's very uncharacteristic of the size of the company that he bought. Right? Usually they look at companies in billions of dollars, and he bought like 28 newspapers just for $348 million.
I second that, Satya, that, generally it seems like a very contrarian bet. On one side, he's understand how the technological advancements are taking place, but on the other side, I don't understand whether it is his love for newspaper or media that he has gone and bought 28 newspapers.
Well, it was his love for the media, sure, but he's giving an explanation as to why he invested in 28 newspapers. He's saying that, of course, now you will use the internet to look for national news or to look for stock market data, etc., or the sports news, etc. However, you will still rely on the local newspaper to know about the local affairs in your surroundings. You want to know what the mayor is doing. You want to know about the high school football scene. You will look at your local publication. And all these publications are generally monopolies in their locality. So they have a customer base. And all of these now also have an internet presence. So yes, people are also moving to the internet. Warren was saying that initially, yes, all of these newspaper publications were giving internet newspapers for free, whereas the physical copies came at a cost. So in a way, it was a self-killing purpose where they were, where the internet was cannibalizing their revenue-generating physical copy business. But he's saying in the previous 2 years, that is roughly around 2010, a lot of these internet news portals have started installing paywalls or subscription models. So just like you pay for the newspaper every month or every quarter, you also start paying for these internet-based newspapers every month or every quarter. So he's saying that a lot of these businesses now have had a sensible internet strategy, and that is where they will make money. Newspaper might just die, but their internet media business will continue, and that is where he's hoping to make some money. However, having 28 newspaper companies means that he could be accused of trying to control media, etc. But he's giving an example of how he's not doing any of that. There were 12 newspapers in all his subsidiaries that had endorsed a presidential candidate. 10 of them had endorsed Mitt Romney and only 2 had endorsed Obama. Warren himself voted for Obama. So he's saying that these media houses will continue to have their independence and they will also not try to influence each other. The strangest thing, however, is that while he bought these 28 newspapers in 2012, in 2014, he exited Washington Post.
What?
Yeah, that news was widely covered in media. It was an end to 40-year relationship with the Washington Post.
But why would he sell that?
Warren had some stake in Graham Holdings, which was the parent company of the Washington Post. Now, Graham Holdings had sold the stake in the Washington Post to Amazon's Jeff Bezos. Now, after a few months, Berkshire Hathaway also sold stake in Graham Holdings. That's the end of the relationship with the Washington Post. Of course, it was considered as one of the big transactions where taxes are not levied because it's not a cash deal, it was a share swap deal. For exiting the company Graham Holdings, Warren Buffett and Berkshire Hathaway got some other company, a Miami-based television company in as a deal, as well as some cash.
So Vineet, we have discussed what is happening in the business, which is really commendable. Now let's talk about some acquisitions around this time.
Sure, let me give you a quick run-up of all the acquisitions that happened around this time. First is Heinz Ketchup. Now, this was in fact done through a JV, which was a partnership between Berkshire Hathaway and a private equity firm. This JV bought Heinz Ketchup. So roughly Berkshire Hathaway had about 50% stake in Heinz. And then second is Duracell, which was not a direct acquisition, it was a bolt-on acquisition. So Berkshire subsidiary Marmon, which already had more than 150 subsidiaries, acquired Duracell for $2.9 billion. Then third is Van Tuyl Automotive, which was renamed to Berkshire Hathaway Automotive. This business owned more than 76 automotive dealerships. Then the fourth is the largest ever cash acquisition so far. This is Precision Castparts. They made aerospace components for the aircraft manufacturers, and it was Todd Combs who introduced Warren to this business. And the fifth is not an acquisition, but it is a new business that they started in insurance. It's called the Berkshire Hathaway Specialty Insurance. They were writing insurance for commercial clients. So far, they were only giving reinsurance to other businesses. Now they are also giving insurance to commercial clients. And the sixth is actually a spoiler. It's not an acquisition. It's just an investment that Warren is not talking about in 2016 letter. But let me still bring it to you because it is everywhere in the media. 2016 is when they first picked a small stake in Apple.
Finally, a FANG stock after so long, but nonetheless to say that Apple did become one of the largest investments in Berkshire Hathaway. But Vineet, that was quite a run-up.
Yeah, there are now so many companies under Berkshire Hathaway. Warren also wants to pass on the baton. He has chosen Todd and Ted. He knew for someone to have success in investments, they have to have a good business experience, and for someone to have a business experience, they should have an investment experience. So Warren has selected one company to each Todd and Ted, asked them to manage as if he would manage it without much involvement, but as a chairperson. These companies are not like other bigger companies that Berkshire has, but companies with great earnings prospects.
This reminds me of the business studies lesson that we would get in, 11th and 12th when we were there. In commerce, they would particularly teach us 14 principles of Henry Fayol, 14 management principles of Henry Fayol. And I remember one of the principles was authority and responsibility, which actually meant that if you want to make someone responsible, you also need to give them authority. Without authority, the person cannot be responsible for that thing and even cannot learn responsibility. And, I think Warren Buffett is doing something very similar, that how he wants Todd and Ted to learn about responsibilities by giving them respective authorities.
That's a nice textbook lesson, Astha. So Warren Buffett had given his investment managers, Todd and Ted, $2 billion to begin with. And by now, they have performed well and are each managing roughly $7 billion. And how is Warren compensating them? Of course, they have a fixed component. But there's also a performance-based incentive. Interestingly, that performance-based incentive is based on two components, 80% of their own performance and 20% of the other guy's performance.
Wow, what a nice way of inducing cooperation within the organization.
Yes, he wanted them to cooperate. And they did cooperate on an investment. It is direct TV. Warren is saying that, in fact, you will see in each of these letters, he's listing down the largest listed securities that Berkshire Hathaway is invested in. Around this time, they are listing only securities. They are naming only the securities that are more than $1 billion for Berkshire's investment. So he's saying that in 2015 and 16, in fact in 2012, there was Direct TV in this list, which was not picked by Warren himself. It was picked by Todd and Ted together. And they had invested $1.15 billion in it. Warren is saying this because every time Berkshire Hathaway picks stake in any company, everyone starts saying that Warren's smart picks, Warren's hot picks. This pick was not Warren's, this was Todd and Ted's. So he's saying that now this list is Berkshire Hathaway's, but not Warren's alone.
So Vineet, if there's any stance to how Todd and Ted's performance was according to or as per Warren.
Well, that's very interesting. So 2012-13, we've seen how Berkshire Hathaway is underperforming the S&P 500, but Todd and Ted each outperformed the S&P 500 by double digits. So Warren is, in fact, when he's mentioning that Todd and Ted have outperformed, he's mentioning it in very small fonts in the letter, so that not many people can read it. And in fact, Charlie's saying, you should say that they outperformed you by a lot. And he's saying, if this humiliating comparison continues, I will just stop talking about them.
So Vineet, finally we have come down to the last segment of this episode, and it's 2014, which means that Berkshire Hathaway has completed 50 years. And I remember when we talked about when Berkshire Hathaway had completed 25 years, then Warren Buffett had enumerated the mistakes that he has done, which could be a nice learning lesson for the investors. So what all he has to say since Berkshire has completed 50 years?
Yes. So this time he's not enumerating his mistakes because he said he will give more regular updates and that he's been doing year after year. But he is commemorating the 50 years by talking about the past of Berkshire, the present of Berkshire, and the future of Berkshire. So let's talk about the past. Firstly, Warren is saying that buying Berkshire was a big mistake.
I remember that.
Because he was following the cigar butt investing. But Charlie straightened him out, and Charlie told him that in order for you to build a long-term scalable business, you need to have long-term earnings growth prospect kind of an approach and should acquire businesses with long-term earning growth prospects. So, in fact, he's saying in the last 56 years that I have known Charlie, we've never had an argument. Whenever we differ in our opinions, Charlie simply ends the conversation by saying, think it over, Warren, and you will agree with me because you are smart and I am right.
Nice.
So in fact, Warren is saying that listening to Charlie paid off well. And he's also pointing out an interesting fact that Charlie was into architecture. So by qualification, Charlie was a lawyer. By profession, he was an investment manager with Warren. But by hobby, he was an architect. He had designed his own home and had designed a few dorms for a few universities, and was also continuing to do that in his leisure time.
Vineet, very few people know, but the way you quoted how Charlie's journey has been, I can relate to it because I come from a lawyer background, a legal background. I am into somewhere investments. I don't know where the future will take me, but surely I can take inspiration from Charlie.
You're manifesting.
Yeah.
So yes, Warren is saying that Charlie practiced architecture as a hobby, but he was also the real architect of Berkshire Hathaway. It was his thinking that helped shape Berkshire Hathaway the way we know it today. Now let's talk about the present of Berkshire Hathaway. It's a conglomerate structure. It is known, so conglomerates are generally known for being notorious in the way they are managing their affairs, in the very confusing accounting principles that are there. However, Warren is confident that they have been able to use the conglomerate structure to their best advantage. Now let's say as an investor, you want to invest in this sector, sector A, and a few years later, you think that sector B is more favorable. You'll have to take money out of it and put it here. In doing so, you'll have to pay taxes, you'll have to bear the transaction costs, advisory fees, etc. When you're invested in Berkshire Hathaway, Warren and Charlie will take care of that for you. The businesses that are doing well will be given more capital, or it's easier to move capital from one business to the other. So he's using it more advantageously. Another point is a lot of market gurus or observers have been saying that Berkshire Hathaway should spin off a few large subsidiaries. Now Warren is saying that these subsidiaries were working independently. They had their own policies, their own ways of operations, and Berkshire Hathaway was not forcefully imposing its own ways of operating on them. So they were working independently. And another part is, if they became independent, they will have to install their own board. So their compliance costs will go up, remuneration for board members will go up. So it seems like an inefficient structure. Why would you want to spin them off? Warren wants to keep them under Berkshire Hathaway. Now, let's talk about the future of Berkshire Hathaway. Now, Warren is very confident that Berkshire Hathaway will continue to grow its intrinsic value. Its market value will accordingly keep growing. However, he's saying that that growth will nowhere be close to the 50 years of growth that Berkshire Hathaway has so far seen. They are much bigger in size and the dynamics have changed for them. So far, they've not given any dividends, but there will come a point in future when the existing managers of Berkshire Hathaway will realize that they cannot very efficiently allocate capital. So they will have to give dividends or engage in more repurchases or do both. Now, another point is about the risks. Warren is saying that there could be a 1 in 1,000-year flood. Berkshire Hathaway is prepared for it.
Correct.
Now, Warren is saying that every company is supposed to list out all the risks that they face in their annual reports. However, what these annual reports lack is that they do not explain the probability of these risks happening, the cost that they would have to incur for these risks, and the timing of these risks happening. Warren is saying, come what may, they are prepared, they have accounted for all the probabilities, and they are a fortress of capital. They are maintaining huge cash pile. Even if there was a calamity that was 3 times the size of anything that mankind has seen so far, Berkshire Hathaway will be able to honor all the claims and still be profitable and perhaps have cash to do more acquisitions that very year.
You see, I really like Warren Buffett's philosophy around what risk could occur, because as we saw when COVID happened, it was a worldwide pandemic. Every operation had come to standstill. So could anybody who could have predicted it? Maybe to not the extent to which the impact had caused. To somewhat maybe, okay, something like this could have happened. But the extent was massive. And when Warren Buffett is saying that if you are imagining a risk which is beyond your imagination, we are ready for that, I think a lot of organizations should consider this factor, which is very important, and maybe start, enlisting them in their annual reports.
However, he's also saying that the kind of risk that they are not prepared for is the risk that they also share with every other American citizen. Let's say there was a biochemical or a terrorist attack or a cyber attack on all of the nation. They are perhaps not prepared for that. But beyond that, as a business, whatever business risks that could come their way, they are very well prepared for even a 1 in 1,000 possibility.
Wow.
Now moving on, Warren is saying that Berkshire Hathaway has a very strong financial staying power, meaning they have a very stable and diversified streams of earnings. They have huge cash liquidity, and they do not invest in businesses that require sudden cash liabilities. So that way they are in a strong stead. And lastly, the CEO. They've identified the CEO. They're not naming him or her yet. A CEO who has grown from within the organization and is not looking to retire by 65. You can see how Warren and Charlie are working well in their 80s and 90s. Warren is saying that the CEO candidate or the backups have a broad understanding of the business, but they also understand their limits. And he wants his CEOs to always avoid the ABCs of business decay: arrogance, bureaucracy, complacency. He wants his CEOs to always be cognizant that their personal arrogance or the need for bureaucracy, or they should not be fostering complacency in the business. That is how he's going to ensure that the culture that he and Charlie have put continue to exist, and that is how Berkshire continues to exist.
Very nicely put.
We've heard a lot about what Warren had to say about the 50 years of Berkshire Hathaway. Mind you, Charlie also for the first time had contributed to this letter. He also has written so much about Berkshire Hathaway, the policies in it, and of course about Buffett. There are so many categories that he's mentioned, but I'll touch upon only a few. He talked about Buffett's investing style, how it is, unique. He says that Buffett is good for the same reason Roger Federer is good at tennis, because both of them actually focus on only few things in their life and master in them. Of course, Munger also talked about the policies in the business. Of course, these are the policies and the key points that we have enumerated n number of times in the previous episodes as well. Let me just take one by one. First, they're not comfortable taking debt. Second is about dividend. We all know that Berkshire Hathaway doesn't pay any dividend because they want to earn more than $1 when they invest that $1 in the business. The third, we all know that how they look at valuations and buy good businesses at fair prices. They also want the right CEOs for the businesses when they're acquiring the company itself. If they don't have the right CEO, they look for right CEO, but they also look for qualities. The 4 qualities that they look for in a CEO are talent, skill, energy, and love for the business. If all are met, then they know that they found the right person for the business. They also gave autonomy to the CEOs. We know that Berkshire Hathaway doesn't involve in the operations of any business because they gave full power to the CEOs in the business. Next, about the retirement age, there is no retirement age that Berkshire Hathaway imposes on its subsidiaries for its CEOs. And what else? We all know that Berkshire Hathaway doesn't sell any subsidiaries just for the sake of earning more profits. They are forever investors. So these are some of the points about the management and policies at place in Berkshire Hathaway that Charlie Munger have enumerated. He also mentioned why Berkshire Hathaway has been very successful because of the peculiarity of Buffett, the peculiarity of Berkshire Hathaway. He did not rule away the importance of luck. The third important point is good luck. 4 is immense support from the shareholders. Of course, he also talked about the succession planning. A lot of people think about what happens to Berkshire Hathaway if Buffett leaves. He says the company is in good hands and there are good people who can take care of the business. He mentioned Ajit Jain and Greg Abel, referring to them as not just world-class leaders but world-leading leaders.
So while he's not calling them as the successors of Warren and Charlie, he did mention that they are capable of taking over the reins in case Warren and Charlie were to pass on.
So we can say they're like, I'm not saying that they are like, the next Charlie and Buffett, which is Ajit Jain and Greg Abel. But all the points that the two of you have mentioned, of course we have talked about them widely and discussed them again and again because they're very important and certainly are a gem.
Sure. Now, one interesting bit that I want to talk about. Have any one of you heard of longbets.org?
Yes, it is Amazon's Jeff Bezos backed non-profit organization. Longbet is something where there'll be a proposer who will propose that a particular thing will happen as on a particular date. Now, this person has to wait for the counterparty to come and say that this may not happen. This is the bet. When both of them participate in it, each of them have to give an essay on why they think that happens, and they have to also mention the amount that would go to charity if either of them loses. There are interesting bets. In 2002, an entrepreneur, Mitch Kapoor, asserted that by 2029, no computer in the world will pass the Turing test, which means there'll be no computer which will impersonate a human being. Warren jokingly said that I don't know about the bet, but there'll be no computer which can impersonate Charlie.
I agree with him.
That same year, Craig Mundie from Microsoft asserted that there will be pilotless planes by 2030. Eric Schmidt from Google said otherwise. Now, Warren Buffett had participated in the same bet, taking Eric Schmidt's side.
Yes, Warren took half the risk on Eric Schmidt's side, and he also placed one of his own bets. We know that Warren has long been recommending index funds for retail investors. Around 2007, he placed this bet on longbets.org that an investment professional can choose a group of 5 hedge funds, and over a long period, let's say 10 years, the S&P 500 will beat the average of these 5 hedge funds. And for his side, Warren is saying that he will choose Vanguard's S&P 500 index fund. Now, for a long time, no one came to challenge Warren. Finally, one man came up. His name is Ted Sides. He was a co-manager at Protege Partners. Protege Partners is a fund of funds. It was a fund that would invest in several hedge funds. So Ted Sides chose 5 such fund of funds that were collectively invested in more than 100 funds. Now, it has been 9 years in 2016 since they've placed this bet, and all these funds put together have delivered a CAGR of 2.2%, whereas S&P 500 has delivered 7.1%. So Warren is very confident that in 1 year he's going to win this bet, and the charity of his choice, that is Girls Inc. of Omaha, will be receiving $500,000. Now, he's saying why did S&P 500 beat the hedge funds is because these hedge funds have a very complicated and a very heavy fee structure. When they deliver good performance initially, a lot of new investors flock in with a lot of new money. Second is once this pool becomes bigger because of a lot of money has come in, it becomes difficult to deliver the same kind of alpha. Now he's saying what is possible with millions is not possible with billions. It is what Warren and Charlie have seen. In the initial years, they were able to give much larger returns, and now because of the sheer size of Berkshire Hathaway, they cannot keep growing at that same pace. And third is that despite seeing limited earnings prospects, these hedge funds will continue to invite more and more investors because it adds to their fund management fees. So it is for this that the hedge funds are bound to underperform passive investments, which are near no cost.
So Vineet, what you rightly explained right now, this reminds me of what Warren Buffett said, because as we've generally seen that managers are making money because of, let's say, brokerage or commissions, but investors are the one who are losing it. So that is when Warren Buffett said if there are two people, one who has money and one who has an experience, and both of them meet, so the person who has an experience leaves with money and the person who has money leaves with an experience. And I've never found anything this simple with a great lesson.
So Warren was such a proponent of S&P 500 index investment is that he's saying if ever there was a statue to be erected for someone who has done the most for American investors, it should be of Jack Bogles. He was the founder and CEO of Vanguard index funds, and moreover, again, let's talk a bit about his succession plan. Of course, his shares would go in philanthropy, but his personal cash balance upon his passing away would be 90% of it would be invested in S&P 500 and 10% in treasuries, so that it could sustain his second wife once he passes away.
Okay. Okay, guys, this is actually a really interesting conversation that we are having, but I want to slightly go back and talk about long bets and rather ask you individually, what are your long bets? What will you be betting upon in times to come?
Can we take time?
Well, we've been discussing Warren Buffett's letter for quite some time. There must be some crazy ideas that would run in your mind for the upcoming future.
Well, let's first establish that we have taken some time before answering this question.
Okay.
And I would like to say that by 2035, at least half of India's electricity will be coming from renewable sources.
Wow. And what about you, Satya?
No, I would want to make a bet that in 10 years, mutual funds will have a more share than the fixed deposits.
So both of you are kind of making a bet from 10 years from now, 34 and 35. So I'm marking my calendars with these individual bets. Wherever we are, we're definitely going to talk about how the individual bets did.
And how this episode aged.
As age. So we have reached the end of this episode, but we never end the episode without talking about what we have learned and what the summary is. So since you had too much to talk about, let me kindly quickly summarize of what we learned. Number one is definitely going to be those two stories that we started with and the learnings that Satya shared. That one, don't speculate. And the second is my favorite, that if anybody is promising you quick profits, say no immediately. There is nothing like quick profits. The second thing that I like when we were discussing about book value and intrinsic value with market value and intrinsic value, I like how wonderfully Warren explained that the reason the divergence was caused was because of float and depreciation. And the way we are accounting it into the books, for float, we are not taking the intrinsic value, but rather it is the one which is the cause for intrinsic value. And for depreciation, the book value is the one which is, because of the depreciation, the book value is increasing, but actually it is the intrinsic value which is falling. So this is a really nice way for the analysts when they are analyzing the company. This is something that they need to keep in mind. The third thing that I like was interest coverage ratio. For now, it is an established point the hate that Warren Buffett has for EBITDA, because he really does not like that number, because he understands that depreciation is a cost. You need to account for it. It is an expense. You should look at it. So that is why, rather than when you are looking at interest coverage ratio, it should not be EBITDA by the interest expense, but rather pre-tax profits divided by the interest expense. Next thing that I like was around rolling returns. As Satya rightly explained, that we should not be looking upon point-to-point returns that have been generated, but rolling returns is something that you should be looking at, because it gives you a good average, and also it takes off all the nuances that could be created around point-to-point numbers rather than the rolling returns. Last but not the least, the thing that kind of touched my heart was the productivity gains. I agree that companies are doing well, they are having great productivity, they are unlocking wealth for shareholders, but social cause, the cause that employees are being laid off or we are being replaced by new AI coming in, we need to have safety nets. I mean, government needs to think for it, but we ourselves need to do something about it. If we think that we can be replaceable, let's have safety nets for ourselves. So this was all about the episode number 8, where we discussed from the years 2012 to 2016. The way Vineet and Satya did put some long bets, do tell us in the comments section what are your long bets and what are your learnings from this episode. See you in the next one. Thank you so much.